I don't own gold because I thought it would go to 2,600 or 2,700. I own gold because I'm afraid it'll go to 9,000 or $10,000. While I don't have a price target, I do have a feeling that gold helps me sleep nights and stay calm. And at 71, those are great attributes. In my estimation, gold doesn't go higher, it goes much higher. And in my experience, gold leads. But when the generalist investor adopts the precious metals narrative, which has not happened yet, silver takes over leadership. And when silver takes over leadership, it rises farther and it rises faster.
Gold prices climbed over 1% on Friday, reaching $2,510 after bouncing from daily lows of $2,484, following a notable drop in the US dollar and Treasury bond yields. This surge came from dovish remarks from Federal Reserve Chair Jerome Powell, who hinted that inflation is finally nearing the 2% target and that the time might be ripe for rate cuts. Powell's acknowledgment that the Fed is shifting its focus towards achieving maximum employment while stabilizing inflation sparked a sharp rise in bullion prices. This situation has caught many analysts off guard, including Rick Rule, founder of Rule Investment Media. Rick contends that Federal Reserve Chair Jerome Powell is navigating a challenging situation, balancing the need for inflation control against mounting political pressure to lower interest rates. While politicians push for lower rates to boost growth, some Fed insiders believe high rates are essential to protect the US dollar from the risks of excessive government spending and potential instability. As political pressure on Powell intensifies, there are concerns that a rate cut could echo the events of the 1970s, when the Fed initially raised rates but then reversed course under political influence. This led to a dramatic surge in gold prices, which jumped from $100 to $850 per ounce. Investors are now watching closely, believing that if Powell yields to political demands, a similar spike in gold could occur, and many are positioning themselves accordingly. Silver, too, has shown considerable strength recently, closing 2.73% higher at $29.83 last week. The precious metal benefited from the weakening dollar and falling Treasury yields, drawing increased investor interest amid shifting expectations around monetary policy. Rick notes that while gold usually leads in these market changes, silver often takes the lead and outperforms gold as market sentiment shifts toward precious metals. He and other analysts believe silver might soon break its previous nominal highs. Before listening to insights from Rick Rule's interview, hit that subscribe button and turn on the notification bell to stay updated with all our latest content. Thanks for watching and enjoy the video.
I don't pay much attention to the top of the Fed, which is highly politicized. I'm in contact with some of the lower ranked employees of the Fed. Some of them are my subscribers, and I converse with them regularly. And it's been eye opening. I had a very low opinion of them, and I found out I'm wrong. They're well meaning and well informed people. The bias of the employees of the Fed is to keep interest rates high. They see themselves as the only guardian against the destruction of the US dollar by the political class. They don't think, and I think they're right, that the executive or Congress has any interest in controlling spending. And they think that artificially low interest rates will bring about the demise of the dollar faster than it needs to occur. Powell is between a rock and a hard place. The right thing for him to do is to keep interest rates high. The political pressure on him to do otherwise is overwhelming. When he cracks, I don't know, but I think that there's at least a 90% probability that he does crack. If he cracks, then I think past is prologue. And when I say past is prologue, I remember the first part of the decade of the 70s, when inflation in the gold price in the period 1970 to 1971 went up. In 1975, the Fed decided to raise interest rates. When they raised interest rates, the gold price fell by half. It went from $200 an ounce to $100 an ounce. At the end of 1975, they lost their nerve and lowered interest rates. And you had a ramp in the gold price from $100 an ounce to $850 an ounce. If the Fed capitulates, if the political class makes them capitulate, then I'm afraid gold is really truly off to the races. Remember that all-time high is nominal. If you adjust that all-time high for the purchasing power of the dollar, the all-time high is probably closer to $100. I'm afraid I think we're going to see that price. in my estimation, gold doesn't go higher, it goes much higher. And in my experience, gold leads. But when the generalist investor adopts the precious metals narrative, which has not happened yet, uh, silver takes over leadership. And when silver takes over leadership, it rises farther and it rises faster. And the silver equities, with the possible exception of the uranium equities, would seem to be the most volatile natural resource equities of all. Doug Casey observes that the market capitalizations of the high quality silver juniors, a very small universe, is so small that when the generalist investor comes in the space, there's not enough room in the silo for that money. I remember the early part of the decade of the 90s when we had a spectacular short silver price rally. And we had things like Silver Standard going from 72 cents to $45, Pan American going from 50 cents to $40. You buy these things because you don't know when silver's going to run, and you are willing to subject yourself to breathtaking opportunities because when they do run, the gains that you enjoy pay an awful lot of rent in a time value of money sense to compensate you for being early. I'm delighted right now to see the hate on social media that the small silver companies are enjoying. I think the problem, and we've described this before, is that investors look at a long-term narrative and they employ a short-term strategy. In other words, they think the price of silver is going to go up over 3 years.
According to the Federal Reserve's preferred measure, inflation has decreased from a peak of 7.1% in 2022 to a current rate of 2.5%. However, this figure has sparked debate among voters and analysts about the accuracy of the Consumer Price Index, CPI, in reflecting real-world inflation. While the CPI reports inflation around 2.6%, a figure just above the Fed's target, it does not account for essential costs like food, fuel, or taxes, significantly impacting household expenses. Rick Rule highlights this discrepancy, arguing that the CPI's exclusion of critical expenses leads to underestimating the actual inflation rate, which he believes to be closer to 7% annually. This misalignment is important for investors to consider when evaluating savings yields. For example, if you earn 4.25% on a U.S. Treasury bond, but inflation is reducing purchasing power by 7.5%, you effectively lose 3.25% in real terms each year. Rick warns that if the Fed cuts rates prematurely, potentially as soon as September, it could worsen this situation. Without proper regulatory adjustments, interest rates would need to accurately reflect the dollar's true depreciation and include a risk premium to prevent further economic instability. Let's get back to the video.
Look at inflation. They look at the number that's proffered up as the CPI, which you'll recall we describe as the CPI. If you believe in the CPI, it would suggest that inflation is creeping along at 2.6%, above the Fed target, but manageable. The difficulty is that the CPI doesn't correspond to the basket of goods and services that you and I and other consumers live with. The CPI, when it's inconvenient, doesn't measure food or fuel. As you can tell, it's hedonistically adjusted, which means that they arbitrarily assign values to the place I live and the computers I buy. But the most important flaw with it is that it doesn't include the cost of tax and government. For most North American working families, the largest constituent of household expense is tax, generally larger than rent, groceries, and energy combined. A cost of living index that doesn't include the cost of living is a very odd index. The consequence of that is that I believe the deterioration of the purchasing power of the US dollar is compounding at about 7% annually. It's important to consider that cost of living in the context of the yield paid on savings products. Doing that, if you buy the so-called riskless product, the U.S. 10-year Treasury, and get paid 4.25 in a currency that's losing purchasing power at 7.5, rather than making 4.25, you're losing 3.25 in purchasing power annually. And I think that's the circumstance that investors came to see in the middle part of the decade of the 70s, which is why we had an absolute rout in the long bond and an absolute explosion in the gold price. I think that's what's in front of the Fed today. I suspect if the Fed wasn't in place, if you had a deregulated credit market, which is to say, if you had a market in money, a market in credit, that the interest rate would be the real rate of depreciation of the US dollar purchasing power, which is to say 7.5%, plus a premium for risk. If people are concerned about high housing prices, that would certainly fix that. Imagine if a first mortgage was 10%. Imagine if the prime rate of interest was 9%. Imagine if consumer credit was priced at a premium to prime. Will we get there? I don't think so. And I think that investors need to focus on the delta between the yield on savings and the depreciation of the purchasing power.
The founder of Rule Investment Media forecasts that the US dollar will lose significant purchasing power over the next decade, a shift from the relatively stable economic conditions of 1982 to 2022. He anticipates that gold could surge to $8,000 or even $10,000 per ounce as inflation rises. Meanwhile, silver is also expected to see further gains, bolstered by a dovish Fed and robust industrial demand. Share your thoughts on Rick Rule's analysis in the comments below. If you enjoyed this analysis, don't forget to give it a thumbs up, share it with others, and subscribe for more updates on global developments. See you in the next video.